Welcome to the daily update, where I'll go over the action in the market for Monday, January 22nd, and then we'll see how things look for Tuesday, January 23rd. We had another update, of course, on Friday. The S&P set a new all-time high. So in Monday's session, since we went higher, we set another all-time high. Also, the Dow finally crossed above 38,000. I remember when I first started doing this, they were wondering if the Dow was ever going to get above 4,000. And now, many decades later, we're dealing with 38,000. We're still positive right now, but there are some warning signs as always, and we are looking overextended to the upside when we go through all of our charts, but that can continue for some time. A market can get extreme positive, especially, and then ride that for a while. When we're going down and we hit an extreme negative condition, that tends to produce more of a climactic move in the market that then leads to either a crash or a sudden down move, and then we're able to bounce up out of that. When we're at the high end of the range, that can just kind of drift like smoke drifting in the sky and can go on for a lengthy period of time. Let's go back and talk about what happened. Right at the open, we had a gap higher open. The futures were positive before the market opened, and we went above R1. That's the same thing that happened in Friday's session. R1 was at 48.59, and then that set the intraday high, and I have the word set there for 2 times. As the day went on, prices then drifted lower, closing below R1. So we set the high right after the open, and it just kind of drifted down. We were still up on the day, but there wasn't a lot of follow-through buying like we saw in Friday's session. We were up 0.22% on above average volume. So we've been above that as far as the volume is concerned. We are positive, and we'll go through the charts here. It's still about inflation and interest rates. The interesting thing, and the thing that I've been honing in on over the last couple of trading sessions, is that in Thursday and Friday's session, interest rates went up and stocks went up. Well, stocks went up on Monday and interest rates actually went down. So that gave some support to stocks that's more normal for what we've been seeing lately. We're keeping an eye on earnings as they are released. We're kind of getting right into the thick of earnings season now. And we're also keeping an eye on the geopolitical events to see if they have an impact on the market. Some comments. We did set another new all-time high for the S&P 500, the Dow, and the NASDAQ 100 since they were both up. And we didn't really see a lot of strength in the NASDAQ or NASDAQ 100 on Monday. Small caps are still showing some improvement. We're wondering if that January effect is going to come back into play. The broad market ended up outperforming, where in Friday's session, the mega caps really led things higher. In Monday's session, the mega caps did okay. There were some that were down, but it was the broader market that really participated in things looking more positive. Discretionary continues to be under pressure, and the big stock in there that's really pushing things down is Tesla. It's down, I think, about 16% so far in 2024. Amazon was also down. That's another area of discretionary. And you take both of those together, and we're seeing that negative divergence between the S&P going up and discretionary actually going down. On a short-term basis, we have the Stochc RSI, Williams Percent R, the CCI 14 and 20, stochastics. These are the usual charts that become extreme positive whenever we move. The standard deviations chart, and now we have the RSI, and I'm spelling things all crazy here. The RSI based on 9 periods. In the intermediate term, we still have a pretty long list. The rate of change going back 50 periods, the Arun, our oscillators are showing some improvement. We'll look at all of those here in just a moment. Some of them are still extreme. Some are below their moving averages. Some are starting to turn back up. We have the Sean trend meter. The bullish percent index for both the NASDAQ 100 and the S&P are both above 70 now, so that's getting more extreme again. The percent B indicator, we're still above that upper Bollinger Band, and the new high, new low study based on 10 periods. Long term, we're still above the 150 and 200-day simple moving averages. We're still working through this scenario, and it's adjusting a little bit each day, but the same basic story that we're watching unfold has not really changed all that much, that the Fed could possibly be done raising rates, even to the point of cutting rates at some point in 2024. But we're keeping an eye on the economic reports, because if they continue to come in strong or start to come in strong consistently, that could really force the Fed to come back in and actually raise rates. The dollar was up and interest rates were down. We closed at 4.09% for the 10-year yield. We're still above that 4.02% that RenMac determines can bite into corporate profits, but we did see rates come down slightly. The 10 to the 2 and the 10 to the 3-month yield curves still remain inverted. Sentiment is positive. Even with the update, we ticked down a little bit. We were at 72 after Friday. We closed at 71 after Monday. And we're still positive, though, and we're not necessarily extreme positive. When we get to 75 or above, that's when we're getting extreme, and that's when we start to use sentiment as looking, okay, now we want to do the opposite of what most of the crowd is actually doing. Our trend is still positive. The green line's on top. The ADX, they're both trying to turn up, but they haven't crossed above their moving averages yet. We are positive with our bias as well as our momentum. Then the economic reports that came out, we just had the leading economic index, or LEI. It came in down 0.1%. That was better than the down 0.3% that they had expected. Last time it came in down 0.5%. And here's a chart of that. This is actually from the Bureau of Economic Analysis, the Conference Board. This comes from their actual website, and they also put real GDP on this as well. Real just means that it's taking inflation into account. And that's the kind of gray line here, where GDP is still holding up okay. But when you look forward, leading economic index, it's still quite negative, even though it's starting to turn back up. Now, if you are in the camp that thinks we're going to head into a recession, this is one of your main sources of information to support that. We've been going down with the LEI, and even though we're coming back up, we're still getting a very low reading. Now, there's other charts that we look at, specifically when we look at employment. Those are still looking pretty strong, and they suggest that we might not be going into a recession. So that's why we're going back and forth with this debate. Here's another chart that I got from Edward Yardeni, where it has the leading and coincident economic indicators. The blue line that we just talked about, that is we didn't just talk about that. That's the S&P 500 forward earnings. And that's what's keeping the market going higher, because this forward earnings is continuing to go up as well. What we had just talked about was the leading economic index, and that's the red dashed line. And that's what's been declining. And that's looking out into the future. Then we have the green dashed line here, which is the coincident economic indicators. And this is more of what's happening right now. This isn't necessarily looking out into the future. This is where are things at based on the economic reports that are closer to right now. And these continue to go up. We're looking out into the future, we tend to decline. Well, you might think, okay, that might suggest that going down the road that things could turn negative. And that's certainly possible. Look at other times when these started to really come down and more or less confirm each other. And a lot of times we would go into a recession. So what we would need to have to go into a recession is to see the blue line and the green line start to turn down and confirm the red line going down as well. Then some Isabel Net blog charts. This is put out by Carson. It says, don't fear new highs. This is what does the S&P do after it hits a new all-time high, but it took more than a year for that to happen. And you can look out, and if you look at these little green dots going all the way back to the 50s, it looked pretty good, but then sometimes we see some really bad things after that, getting more closer to where we're at now, where we did set a new all-time high back in 2007, and then after that was the great financial crisis. And then we did go along pretty well in 2012. Then 2016, that was Brexit. That was the election, where the market didn't really react to the election, but it did react to Brexit. And then we were going up, and then we had the whole COVID crash after that. So we can have some confidence in the shorter term, but looking out, that doesn't necessarily make us immune from the market really going down at some point. Down in this box, it might be a little hard to see, but we do see the statistics 1 month, 3 months, 6 months, and then a year out going forward, and how the market performed after that. This is looking at EPS or earnings per share estimates. First, we break it down on a quarter by quarter basis, and this is a consensus, and they're looking pretty strong right now. Then over on the right-hand side, that's looking at everything annually, and this is the Goldman Sachs forecast, that's in red, and then the gray area, that's the consensus, looking at the entire year. Here's the intraday chart where we gapped higher, right about at R1. We went above that not too long after the open. That's when we set the intraday high. We came back down and then just drifted sideways until we went into the close. There was not a lot of movement. Here's the intraday chart where we were flat as we closed for the weekend, and then we did open up higher in the Sunday afternoon or evening session, and that's where we got a lot of the strength from. Europe had a pretty good day. Then we go into the cash session, and we're pretty much flat in the initial overnight session before we go into Tuesday's session. Here is the look at growth versus value, and we're still hanging in there okay. The blue line is still above the red line, even though it didn't have any kind of a gangbuster day. Here's looking at S&P growth to value, where it actually ended up closing down just a little bit. But when we look at the bigger picture of this chart, we go back to about January 8th, and we've been seeing a real improvement with growth versus value. Then we look at our end of day charts where growth was up, but it was up less than value for the large caps. It was exactly the same for the mid caps, and it was up for the small caps, but less than value for the small caps. So looking at the end of day chart for small cap growth versus value, we are starting to come up more into the higher end of this range. And this showing some improvement could be encouraging because you look at the index here and it's starting to go back up. This is one of those things, though, that can be kind of frustrating because we've been breaking out at other times with the small caps, only to then see a lot of those gains end up being given back. When we look at the mid caps, this is looking a little stronger. We had already broke out of this upward sloping sideways trend that we had been in, and we're in a longer term uptrend as the mid caps are showing just a little bit more of an improvement here. Looking at S&P growth to value and taking the ratio, this is also showing some improvement. We haven't really broken out yet, but it sure beats this negative divergence that we were seeing when the S&P was going up and the growth to value ratio was going down. Here's another measure of growth to value. This is looking more positive. We're breaking out above this previous high right here, but we still have a ways to go to get back to the all-time high with this ratio. Looking at discretionary, this is one of the warning signs. The S&P is setting new all-time highs. We were up with discretionary, but we haven't been able to surpass these previous highs, where staples are now starting to decline. When you take them together and look at the ratio on the bottom, we are seeing some improvement here, but we need to see more follow through than what we've been seeing up to this point. Looking at our trend, we are turning back up with the ADX, but we're still below the moving average. However, we would still default to positive because the green line's on top and now advancing. Here's the short-term chart. We haven't quite crossed over the moving average yet, and the green line is also on top. Volume continues to pick up, and we're getting above average. Here's sentiment. First, looking at this composite chart here, where we look at the American Association of Individual Investors, the bullish percent indexes, the put-call ratio, the active asset managers, and the VIX. We had been more in this red area, and with this latest chart, we're coming down right on the border between extreme greed and just flat-out greed. When you take this and put them all together like they do, we're right about at this extreme stage. Here's the ulcer index, which is still below the moving average and continues to decline. This is showing there's not a lot of fear in the market. Here's the VIX looking at the line chart where we're declining, as well as the bar chart as fear is going away with the VIX dropping. The VIX of the VIX also continues to drop as prices have been going up. And I finally have the updated version of this chart. And it was what we thought it would be after Friday. We thought the equity put call ratio would go down because we had an up day. That's what ended up happening. We also had the up day on Monday, so this is continuing to go down. So we look at our 5-period moving average. After getting extreme, we have been dropping now, and that's been giving support to the S&P. Here's a longer term look at that same chart after we had become extreme, and now we're starting to drop back down. We're continuing to roll over just a little bit with our 253 period equity put call ratio. This had been declining. We bumped into some problems in early 2024, started to go back up slightly, and now it's just barely. It's really hard to see, but it's starting to turn over slightly. Looking at this fear gauge, where we are declining slightly, this other fear gauge also is going down. So we're seeing more confirmation based on sentiment that there's not a lot of fear in the market. Here's our risk on versus risk off ratio. We're seeing some improvement here, but we want to see this continue if we're going to remain more positive. Our advanced decline line studies, we're turning back up based on price and volume, and we see a little bit of a negative divergence here. We haven't come quite back to this high based on price. We still have a further ways to go based on volume. We were watching volume outpace price as we were going down. Now, if we're continuing to go up, we want to see volume kick back into gear and start to outpace on the positive side. Looking at our new highs and new lows, we did set a bunch of new highs in Monday's session, but we're pegged at the top with our 5 period, and we're turning and going back up with our 10 period. So this is still looking positive. We're above the midpoint with our advanced decline ratio, both with the blue line and the red line. This is positive. Accumulation distribution actually ticked down just a little bit. We didn't see a lot of action, positive action in the mega caps like we have been. And when that has happened lately, sometimes we'll see this indicator actually start to go down a little bit, but we're still above the moving average. We're seeing some improvement though with the Chaikin money flow, another smart money indicator. The moving average is now starting to turn and go back up. Looking at our cumulative NYSE advanced decline line, we did show some improvement here, and then our regular advanced decline line also went back up. When we look at just common stock, we advanced based on price and a little bit less, even though we did advance based on volume. This is what we're watching for right now. We want price and volume to be at least equal with each other, not have volume outperforming to the downside and underperforming to the upside. Here's our other NYSE advanced decline line where we are seeing some improvement with this. Looking at our advanced decline line studies, we are turning up with the common stock with the NYSE. We're going back up with the S&P 500, showing some improvement with the mid caps and showing a little bit more improvement, but still has a ways to go to get back to this previous high when we look at the small caps. Here's the daily chart where anytime we go up now, we set a new all-time high. On the bottom, we were above average with volume. This hasn't changed as far as the decision point scorecard. And now looking at our extreme positive short-term indicators, we have the Stoke RSI extreme, the Williams percent R, the CCI 14, and the CCI 20. We're not extreme with our moving average study based on 20, 50, or 200, but we are showing some improvement across the board. And we're well above the 20-period moving averages. And I'm probably going to drop this chart unless we start to really go down. You can look at this bar up here. It looks a little bit scary because we set the high and then we closed, went up, and then ended up coming back down. Is that something to be concerned about? We just want to be aware of it at this point. The force index continues to be positive. That's above 0. We're looking extreme at all different time frames with the stochastics in the short term, intermediate short term, and the long short term. And we're just at the bottom end of our +3 standard deviations channel. So this is extreme positive, but not as high as it could be. Intermediate term, the balance of power is going back up. That is positive. It's above the midpoint. We're still positive with the go, no-go system. We're going back up and the blue line's starting to turn up here with the highest high value. The TTM squeeze is starting to bounce up just a little bit here. So that's showing some improvement. We're above 0 and advancing with the ease of movement. We're still extreme positive with the Arun because the green line is pegged all the way at the top. The red line is pegged all the way at the bottom. That's why our oscillator is giving us such a positive reading. We're showing some improvement with the S&P 500 McClellan oscillator, but we're still below 0. So when we look at the summation index, we continue to decline based on price. We're also continuing to decline based on volume. The NYSE McClellan oscillator also showing some improvement, but still below 0. So we're declining with the NYSE summation index based on price and volume. The Swenlin trading oscillator is showing some improvement, but still below 0 based on price and volume. starting to turn back up slightly with the PMO, but we're still below the moving average. When we look at price and volume, they are still continuing to decline. With our PMO studies, we're no longer extreme after getting extreme negative with the PMOs that are rising. We're no longer extreme with the buy signals, but we are extreme positive with the PMOs that are above zero. We continue to be positive with the Elders Impulse system for the S&P. We're also positive with the parabolic SAR. We're actually starting to cross back above the moving average with the slope oscillator. This is our shortest term oscillator that we follow. The MACD is just coming back up to its moving average. So this is starting to show some improvement as well. So looking at all of our oscillators, we're turning back positive with the slope. We're coming back up and looking better with the TSI. The MACD is just crossing its moving average. The PMO is also starting to come back above its moving average, where the PPO is right about at its moving average. That's in the intermediate term, but in the long term, we are still declining with the TRIX and the KST. And this is another look at our moving average rainbow, where we're above all the plotted moving averages. The bullish percent index continues to be above 70. That's extreme, but as long as it keeps going up, that is positive. And the NYSE bullish percent index just hooked back up just slightly. It is still above 50, so it's positive and not necessarily extreme. Where the NASDAQ 100 bullish percent index, it is continuing to go up and is extreme positive. The Chaikin oscillator actually ticked down just a little bit after we got into this initial area of being extreme positive. The money flow index is starting to cross back above 50. That's turning more positive. The ultimate oscillator ticked down, but is still above 50. That is also positive. The vortex is showing the green line going up and the red line going down. That's switching back to positive. The RSI based on 14 periods is not quite extreme positive yet, where we're starting to get extreme with the RSI based on 9 periods. On balance volume is still above an advancing moving average. And we're starting to turn back up with our 250 period moving average studies for the S&P 500. After being extreme and starting to come down, now we're starting to turn back up. We're wondering if that'll be able to continue. The copy curve is also starting to cross over and is looking more positive. The percent B is still extreme positive since we have now closed for 2 days outside of the upper Bollinger Band. The rate of change going back 50 periods is still extreme positive. The Sean trend meter is becoming even more extreme positive. The equal weight did have a good day. In Monday's session, the equal weight did better, but when you take a bunch of days together, it's still underperforming the S&P 500. I don't have any Fibonacci or line studies now because since we're hitting new all-time highs, we have to wait for new Fibonacci retracement levels and new lines to be created as they present themselves. So our different charts, we're looking positive with the Heiken Ashi, we're positive with the Kegi, positive with the Renko, positive with the 3-line break, and we finally have a new X here with the point and figure chart since we printed a new all-time high. This is still looking better with the green X. We're still working off of the pattern that was the signal that was generated here, the double top breakout, which was generated on November 20th. Our longer term charts, we're going back up with the 150 and 200 period moving averages, and we are extreme positive. We're still above this longer term trend line, looking at the weekly chart of the S&P 500, also above the trend line with the NASDAQ 100 weekly chart. We came back down just a little bit with our ratio because the equal weight ended up outperforming the S&P 500 since the mega caps didn't participate as much. This is still a concern where we're setting all-time highs with the Dow. We're not setting even back to this previous high with the transports. That's a longer-term negative divergence. I was reading through what Edward Yardeni was saying. He thinks the transports are going to catch up and actually confirm this at some point. Okay, we'll just have to wait and watch that and see if that ends up being what happens. Until that does happen, we just keep this in the back of our mind that this is a negative divergence. And we're continuing to decline with the utilities, and the transports are still underperforming the Dow. The transports are also showing a little bit of improvement when compared to the S&P, but we need to see this really kick into gear and to keep going. The Dow again set another all-time high above 38,000. We're positive with the Elders Impulse system for the diamonds. We're coming right up to this R1 level for the NASDAQ. This may be providing some overhead resistance here. And we're above R1 with the NASDAQ 100, and this may be providing some kind of support. But these bars are not all that healthy looking. To close down lower than where we opened and to close kind of at the lower end of the bar, that's not positive in and of itself. We have to see if it can turn back more positive and go up, or is this the beginning of some kind of a decline? The QQQs for the elder impulse system still remain positive. We're turning back positive with the momentum for the NASDAQ 100. The small caps, we were able to get above this pivot point and show some improvement here, up almost 2%, but we have a ways to go to get back up to this previous high. We're looking positive with the Elder's Impulse system for the small caps, and we're right at this resistance level with the Russell 2000 small caps. Isn't that interesting? This has been a pretty hefty area. We're bumping right into that now. Can we break out and go above that, or is this going to present some kind of a problem? We're looking more positive with the RSI as we cross above 50. We're turning back up, but we're still negative with the MACD. The mid caps also are showing some improvement, but have not been able to come back to this previous high set in 2023. And the mid caps still remain positive with the Elder's Impulse system. The FANG index, also kind of a scary looking bar here, but did set another new all-time high. The dollar is rebounding still, even though it's in a longer term downtrend. It has been recovering so far in 2024. So when we look at bonds, we declined with the 10-year yield. We advanced with the 10-year based on price. And I was showing this in the supplemental video or what to watch video. I'm not quite sure what to call that right now. I posted the first one on Monday for Monday's session. And this is just showing how bonds are underperforming stocks. And some of the other charts that I've already talked about, I also included in that video. When we look at the broad market, the S&P 500 with shorter term bonds, I went over this in the weekend videos, but since we're really breaking out, I wanted to show this chart again, showing how stocks are outperforming. The broad market is also outperforming further out bonds. The tech sector continues to outperform bonds, and the QQQs are also outperforming bonds. We look at the S&P, which is also outperforming bonds, suggesting that the market thinks that there will be a soft landing. But when you look at the home construction, where we're seeing some warning signs when interest rates were going up late last week, this is not producing really any concern. This is showing that the home construction area is outperforming the rise in interest rates. Possible positive scenarios. We're showing some improvement with the Qs to S&P. This is the warning sign that we're seeing. Discretionary is underperforming the S&P, where large cap growth is outperforming large cap value. We're improving with the large caps, mid caps, and even the small caps. It's discretionary that's really causing some problems along with the transports. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We're still below zero with our highs minus the lows, taking 5 periods and spreading that across the broad market, even though it showed some improvement. When we look at the S&P, we're turning back up with our new highs minus the lows based on 50 periods. And the S&P to utilities ratio is continuing to go up. That's giving support to the S&P. We're showing some improvement here with our 19-day exponential moving average of the advanced decline ratio for the S&P. We're crossing back above zero based on price. We're right about back up to the zero line based on volume. That's what we're watching right now. Can volume kick into gear and give more support to price going higher? Or is this suggesting that there's some weakness and that once we start to go down based on price, because of what we're seeing with volume right now, that could lead to more declines? When we look at the Staples S&P 500 ratio, this continues to decline. When this is going down, that usually means the S&P is going up. So what's our outlook for Tuesday? We're still wondering, is this January effect going to come back and make a reappearance? We continue to be 0 for 2 for the trifecta at the end of January, about a week from now. That's when we'll finally figure out what our score will be for the year. The technicals are positive and showing some improvement, but we're also dealing with an overbought condition. We won't have any economic reports on Tuesday, and then we're keeping an eye on all the different geopolitical events. On Wednesday, we're going to get not anything all that major. They're important, but they're not real market movers. The big one is going to be durable goods on Thursday, and then I was incorrect over the weekend. I thought we were going to get another reading for GDP. We're going to get the first reading for the fourth quarter of 2023 coming out on Thursday. So that's probably a big deal because this will be the first time we're actually seeing that number. And then the other big one is going to be PCE prices on Friday. That's the other important inflation gauge that we follow. Seasonally, where we're neutral to negative with the Dow for the 23rd of January, we're flat out positive with the S&P, and we're neutral to positive with the NASDAQ. We are now into the week of after options are expiring. We tend to be up more than down historically. And here is the Carson research where we've been more or less bouncing along here. This doesn't necessarily have us setting new all-time highs, but it doesn't necessarily show the market falling apart either. We'll be on the 15th trading day of January, where we do see some strength here with the S&P during an election year. Wondering if the January effect's going to come back and make an appearance. Chopping more or less sideways in the first quarter when we measure election years. Be aware that we do seasonally see some weakness as we get a little further on into the year. And we're pretty much flat with the Stock Traders Almanac statistics. We do see a little bit of weakness, and then we see some strength after that. And we're not really, well, you could maybe make a case for that. We're seeing a little bit more strength when we're setting these all-time highs in the Dow, NASDAQ 100, and the S&P, but we haven't really been breaking out that much when we have the current president who is running for re-election. At least we think that's the intentions right now, but that could change. We will be in Tuesday's session. It tends to be the most negative day of the week. And then our scenarios. Can't really go with the down one right now, even though we are overbought. If anything, we would go with the up scenario, but please be aware that we are overbought. We want to see volume do a little bit better. The idea that we're still, when we're going down, volume is picking up. When we're going up, volume seems to be slowing down. That's a bit of a concern. We're not going with the sideways trend. It looks like the ADX charts are starting to turn back up, and they may cross above their moving averages while still being above 20. So that means that we don't go into a trendless environment. We actually switch from more of a negative back over to a positive environment, which we've already done. But then if we cross above the moving averages, the trend shows that it's getting stronger. The warning signs, the risk on posture, yeah, it'd be nice if this was performing a little bit better. It's improving, but it's not really breaking out. The transports continue to negatively diverge from the Dow. The 1 to 3 month short-term bond spread continues to be positive where it should be negative. The oscillators are showing some improvement. They had been rolling over after being extreme positive, but we're seeing some that are still more negative and some that are starting to turn back up. Our longer term oscillators continue to be negative. Positive signs. Growth is continuing to show some improvement. That is encouraging. The daily special K chart is still positive. We're still declining with our 5-period equity put call ratio as well as the 253 equity put call ratio. The parabolic SAR chart and the vortex continue to be positive. The bullish percent index for the S&P and NASDAQ are positive, and they're starting to go back up, but they are extreme positive. The Zohorchak method, which we saw a full-on buy signal generated last week, that's still there. The Copic curve is crossing back above its moving average and showing an improvement. We're seeing an improvement with the NASDAQ 100 based on momentum, and the Russell small caps and mid caps are working off of uptrends. Small and mid cap growth has been chopping sideways. We're seeing more strength with the mid caps, and we're seeing some improvement with the small caps. The financial sector continues to be positive, and our new high, new low study for the S&P, even though it had been declining in the short term, it's starting to show some improvement there. So our conclusion, we're positive, we're showing some improvement, but at the same time, we are overbought, but we can stay overbought for extended periods of time. In the short term, we are looking better, but overbought. We're still positive in the intermediate term, and we have a longer list of those indicators. And we're also showing some overbought conditions in the long term, but we continue to be positive. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.